Hey, happy Mortgage Monday. Today I'm going to talk a little bit about mortgage insurance and a couple different ways that we can handle mortgage insurance. So, mortgage insurance is something that's required if you do not have at least a 20% down payment on most loan scenarios. And I'm really talking primarily in this video about conventional loans. So, conventional loans, if you're less than 20% down, require mortgage insurance. Mortgage insurance tends to kind of move in 5% chunks. So, you've kind of got one required coverage level at 5% down. It's a lower coverage requirement at 10, lower yet at 15, and then it goes away entirely at 20%. So those down payment percentages are a big portion of what makes up that mortgage insurance premium. The other part of that is actually credit scores. So credit scores are a huge component of mortgage insurance, and they move in kind of tiers, starting at 760 for a credit score or above. You'll have one factor based on the down payment. Between 760 and 740, you'll have another factor, and so on and so forth. Kind of every 20 points changes that factor based on the down payment. There are other components as well that impact mortgage insurance. One single borrower being on the loan versus two will actually change some of the factor as well that comes into play on calculating that mortgage insurance. Mortgage insurance typically is something that people think is done on a monthly basis and kind of added to your monthly payment until you reach that 20% equity position in the house. There are other ways you can do it. So there are loans out there called single premium mortgage insurance where you can actually pay a lump sum amount at closing, either upfront in cash or actually financed into your loan amount, where you're actually making that entire mortgage insurance premium payment up front in a single payment and then not having that monthly component. In some cases, you're actually given a pretty good advantage from a premium standpoint by doing it all up front, and it's certainly something worth considering if you're going to be buying a home that doesn't have 20% down. The third option, which maybe isn't as common or popular at the moment, is something called lender-paid mortgage insurance. So you can actually choose to take a higher interest rate, and that higher interest rate will actually cover the mortgage insurance premium for the entire life of the loan. I think one big drawback in going that route is that once you've reached that 20% equity position, you don't magically get a lower interest rate, and you're going to be paying that higher interest rate for the duration of the loan if you don't refinance. So mortgage insurance, again, something that you may be required to have, but there are a lot of different ways to structure mortgage insurance, and be happy to chat with you to figure out what route might be the best to fit your particular situation. Have a great Monday.